Good morning. We will pay attention to inventory systems today. This business uses the perpetual inventory system and they use the weighted average method to evaluate stock. The weighted average means that they work out the average amount for all the stock that they had available during the year for sales. So to calculate this weighted average, you have to take your opening stock plus all your purchases plus any expenses that you pay to get the goods to your property. That could be import duties or carriage on purchases, less any returns. And you will divide that by the number of units. We will first work out what was the total value of these. Okay, they tell us that on the 1st of July 2015, the value of our opening stock is 55,900. Then we bought stock and paid 324,500, and we paid import duties 23,600. To calculate the total value of our stock, we will take this opening inventory of 55,900 plus the purchases plus the import duties, and if there was carriage on purchases, you would also add the carriage on purchases. Return of sets. 20 sets from the November purchases, that means from this purchases there where we bought 800, were of inferior quality and returned to the supplier. They credited our account with 3,200. That is the cost price as well as the import duties. So that means this 20 sets are not available, and we can reduce the total cost of our inventory with 3,200. Okay, so we deduct the 3,200, and that means all the inventory that we had available, opening inventory plus purchases plus expenses paid to get the goods to your premises, less returns, is 400,800. Now we will do the same with the number of units. My opening number of units was 430. And we bought 2,200, that increased the number of units, and we returned 20 sets. Okay, so we will calculate now how many sets that we have available to sell. We had 430 at the beginning of the year, plus the 2,200 that we bought, minus the 20 that we returned. So in total, the number of units is 2610. If we divide the units in the total cost, it will give us an average price per unit. Okay, we have to calculate what is the value of our closing stock in this question. You cannot calculate the value before you didn't do this calculation to determine what is the average price. So whenever you see that the weighted average method is used, you have to take the opening stock, purchases, expenses, and divide it by the opening stock numbers, purchases, returns, to ensure that you know exactly what was the total cost, divided by the total number of units available, and that figure we will multiply with the number of units available at the end of the year. Okay, this was given to us that the number of sets that we have at the end of the year is 210. So if we multiply the 210 sets with the value per unit, we get the total value, and we can round that off to 32,248. In the next question, we have to calculate the cost of sales. That means we have to work out what is cost of sales. Because we are using the periodic inventory system, we don't calculate cost of sales every time when we sell something. We will determine the cost of sales at the end of the financial year. So we will take our opening inventory, 55,900, plus our purchases, 324,500, plus our import duties, 23,600, minus the returns, 3,200, and we just calculated the closing inventory as 32,248. So to calculate the cost of sales, we use our opening inventory plus purchases less closing stock, and that will give us the cost of sales figure as 368,552. So remember, to calculate cost of sales, you take your opening inventory, your purchases will be all the expenses that you paid, less the closing inventory. In the next question, we have to calculate the gross profit. So we need the sales price less cost of sales to calculate gross profit. And they say that we've sold 2,400 sets during the year, and the total sales price was 720,000. The sales price of 720 minus the cost of sales that we calculated, 368,552, will give me the total gross profit that we made. If they ask us to calculate the percentage profit on cost, they say profit on cost. So that means you have to put the profit at the top, so the one that we calculated there, and we must put the cost of sales at the bottom, the one that we calculated there, times 100 to determine what is our profit percentage. Rounded off, the profit percentage will this be 95.4%. In the next question, we have to calculate the rate of stock turnover for the current year. To calculate rate of stock turnover, we use the cost of sales figure and we divide it by the average stock for the year. That means we have to take our opening inventory and our closing inventory, add them together, divide by 2 to see what is my average stock. And if I divide that into my profit, I will get 8,4 times a year. In the previous year, the gross profit was 360,000. The markup percentage cost was 120%, and the rate of stock turnover was 6 times per year. Now we have to refer to the information that we've calculated to see if it was worth changing the profit percentage. Because we're making a smaller profit, in the previous year the profit was 120%. In the current year, the profit percentage is 95.4%. So we reduced the profit markup. Now we must decide, we've reduced the profit markup from 120 to 96%. Was it worth it? Yes, because our sales increased, because the rate of stock turnover increased from 6 to 8.4%. So this stock turnover rate indicates to us that we are selling more than we sold in previous years. Remember that our sales will now per unit be smaller because we're making a smaller profit. But the stock turnover tells us that we increased our turnover from 6 to 8.4 per year. That indicates that we replaced the stock 2.4 times more than in the previous year. Our gross profit decreased from 360,000 to 351. So although there was a major reduction in the profit, our gross profit didn't change a lot. It's only 8,552 that we've lost, but we sold a lot more articles. It happens that you have to reduce your profit because competitors are selling the things at a lower cost, or that you have stock that you want to get rid of, and then you have to decrease the profit markup so that you will sell more stock, and if you increase your turnover, it will help you with your gross profit. The owner wants to know what the value of the closing stock would have been if the FIFO method had been used. Okay, if we use the FIFO method, it means that we will take the last stock that we purchase into account to work out the closing inventory, because the things that we bought first, we sold. Then the second lot that we bought, we sold. Third lot, we sold. So the only ones that's left over is the units of the last purchases, 210. The cost of those units were 160 Rand, and the import duties was 12 Rand. So if we multiply the 210 with the 172, the closing inventory would be 36,120. The closing stock, when we use the weighted average method, was 32,248. So remember that figure, 32,248. So when we use the weighted average, we will get 32,248 for the closing inventory. If we use the FIFO method, the closing inventory is 36,120. Now, why is there such a big difference? In the first in, first out method, you will see that as we purchase goods, the price of the purchases increased every time. So what did we do here? We sold that cheap ones that we bought in the beginning, then the second lot that was a little bit more expensive, then the third lot that was a little bit more expensive. What is left over at the end of the year? The units that we purchased the last time that was the most expensive. That is why these units multiplied with 170 cost gives a higher stock value than the one where you work the average price of the whole year. The first in, first out method is more reliable in the sense that if I want to replace this inventory now, this will be my price that I will pay, 36,120 for 210 units. And the weighted average, you will not get it at that price. What is the advantage if you use the first in, first out? The closing inventory is higher. Now remember, how do we calculate cost of sales? Opening inventory plus purchases less closing inventory. So therefore, if my closing inventory is higher, my cost of sales will be lower. And if my cost of sales is lower, my gross profit will go up. So if we change this to the FIFO method, we will have a bigger gross profit. But remember, this will only happen in 1 year, because the next year you will take over this weighted average amount and you will work with that in the next financial year. You are not allowed to swap from one method to another method just to increase your profit. It's unethical. If a business decided to use a method, they have to keep on using that method.